The rise of the media. The bubble was added and abetted by the media, which turned us into a nation of traders. Like the stock market, journalism is subject to the laws of supply and demand. Since investors want more information about internet investing opportunities, the supply of magazines increases the filled-up need. And since leaders were not interested in the downbeat skeptical analysis, they flocked to those publications that promised an easy road to the rich. Investment magazines featured the stories such as internet stocks likely to double in the month ahead, as James Bryant Quinn remarked. It was investment pornography, softcore rather than the hardcore, but pornography all the same. A number of the business and technology magazines devoted to the internet pricing up to satisfy what seems to be an insatiable public desire for more information. Wired described itself as the vanguard of the digital revolution. The industry standard was a new weekly of the Internet economy, and Business 2.0 prided itself as the oracle of the new economy. The proliferation of the Republicans was a classic sign of a speculative bubbles. The historian Edward Chancellor pointed out that during the 1840s, 14 weeklies and 2 dailies were introduced to cover the new railroad industry. During the financial crisis of the 1847, many of the real Republicans perished. When the industry standard failed in 2001, the New York Times editorialized, "It may well go down as the day that was the days." The Internet itself became the media. No longer did the individual investor have to consult the Wall Street Journal or call a broker to get a stock's price quote. All the information was available online in real time. The website provides stock summaries, analysis ratings, past stock charts, forecasts of the next quarter's earnings and long-term growth, and instant access to any news items about almost any stock. The Internet had democratized the investment process, and it played an important enabling role in perpetuating the bubble. Online brokers were also a critical factor in fueling the Internet boom. Trading was cheap, at least in terms of the small dollar amount of the commissions charged. Actually, the cost of the trading were larger than most online brokers advertised, since much of the cost is buried in the spread between a dealer's bid price, the price at which a customer could sell, and the asked price, the price at which a customer could buy. The discounted brokerage firms advertised heavily and made it seem that it was easy to beat the market. In one commercial, the customer boasted that he did not just simply want to beat the market, but to throttle its cranberry little body to the ground and make it beg for mercy. In another popular TV commercial, Schuchert, the cyber Greek from the mailroom, was encouraging his old-fashioned boss to make his first online stock purchase with the explanation, "Let's light this candle." When the boss protested that he knew nothing about the stock, Schuchert said, "Let's research it." After one click on the keyboard, the boss, thinking himself much wiser, bought his first 100 shares. Television supplied continuous air for flooding in the internet bubble. Cable networks such as CNBC and Bloomberg became the cultural phenomena. Across the world, health clubs, airports, bars, and restaurants all permanently tuned into the CNBC. The stock market was treated like a sports event with a pre-game show. So what to expect before the market opened? A play-by-play during trading hours and a post-game shows to review the day's action and to prepare investors for the next. CNBC implied that listening would put you ahead of the curve. Most guests interviewed during the day were bullish. CNBC's commentators liked Maria, the money honey. Baltimore, particularly, favored scheduling the interviews with analysts who could say with confidence that the $5.com stocks, the $50.com stock would soon go to $500. There was no to the reminder CNBC anchor that just as the family dog that bites the baby is likely to have a short dinner surprise, skeptics did not encourage higher ratings. The market was a hotter story than sex. Even Howard Stern would interrupt more usual discussions about porn queens and body parts to muse about the stock market, and then to choose some particular internet stocks. The result was that the turnover reaches an all-time high. The average holding period for the typical stock was not measured in years or even months, but rather in days and hours. Redemption ratios of the mutual funds, the percentage of the fund's assets redeemed, soared, and the volatility of the individual stock prices exploded. The 20 most volatile stocks in each trading day used to raise or fall by 5%. By early 2000, the biggest percentage changes in price were whole 50% or more, and there were 10 million internet day traders, many of whom had quit their jobs to go down the easy path to riches. For them, the wrong term meant later in the morning. It was a lengthy People who would spend hours researching the pros and cons of buying a $50 kitchen appliance would risk tens of the thousands on the chat room tip. Terence Odin, a finance professor who studies investor behavior, found with his colleagues that most internet traders actually lost money even during the bubble. Systemically buying and selling the wrong stocks, and that they performed worse the more they traded. The average survival time for day traders was about 6 months. Okay, let's see the next paragraph. Before we go the next paragraph, so after the internet bubble, so they would like to say the media influenced some stocks, some trend in many ways, especially the CNBC and Bloomberg or others media. So we need to worry about or care about some media, some trends and news and information, many other things. So now I think it is same some current stock market as well, because most of the people get some information from media, the mainstream, some trends, economy, and many other things. So nowadays many people see the YouTube video and news and many other SNS some information. So we need to worry about that and carefully look for that kind of information and make a criteria to do investing. Okay, let's see the next paragraph. Fraud slithers in and strangles the market. Speculative manias such as the internet bubble bring out the worst aspects of our system. Let there be no mistake, it was the extraordinarily new economy mania that encouraged a string of business scandals that shocked the capitalist system to its roots. Many businesses were managed not for the creation of long-run value but for the immediate gratification of the speculators. When Wall Street conflicts, sell-side analysts looked for the high short-term forecasted earnings to justify outlandish the high stock prices. Many corporation managers willingly obligated, and if aggressive earnings targets proves hard to meet, creative accounting could be used so that not only the published street estimates but even the whisper numbers could be suppressed. One speculator example was the raised subsequent bankruptcy of Enron, at one time the 17th largest corporation in America. The collapses of Enron were over $65 billion of market value was wiped out, can be understood only in the context of the enormous bubble in the New York economy part of the stock market. Enron was seen as the perfect new economy stock that could dominate the market not just for the energy but also for broadband communications, widespread electronics trading and commerce. Enron was a clear favorite of the Wall Street analysts, even after it began to unravel during the fall 2001. 16 out of the 17 security analysts covering Enron had buy or strong buy ratings on the stock. All utility and energy companies were likened by the Fortune magazine to a bunch of old fogies and their wives shuffling around the sounds of Guy Rambo. Enron was likened to the young Elvis Presley crashing through the skylight in his skin-tight gold lime suit. The writer left out the part where Elvis ate himself to death. Enron set the standard for the thinking outside the box, the quintessential killer app paradigm shifting company. Unfortunately, it also set new standard for obfuscation and deception. One of the schemes perpetrated by the Enron management was the establishment of the myriad of complex partnerships that obfuscated the true financial position of the firm and led to an overstatement of Enron's earnings. Here's how one of the simpler ones worked. Enron formed a joint venture with Blockbuster to rent out the movie online. The deal failed several months later, but after the venture of formed, Enron secretly set up a partnership with a Canadian bank that essentially lent Enron $115 million in exchange for the future profit from the Blockbuster venture. Of course, the Blockbuster deal never made a nickel, but the Enron counts the $115 million loan as a profit. Wall Street analysts praised and called Kinley, Enron's chairman, the mastermind of the year. Other partnerships with names like Chewbacca, named for the Chewbacca, the Star Wars Wookiee, Raptor, and GD, had similar effects since the force was clearly with Enron. Before the law caught up with him, the force appeared to be with NU Fast 2, Enron's chief financial officer, who made $30 million in fees for running what were supposedly independent partnerships. All the partnerships were kept off the Enron's financial statements. This had the effect of inflating earnings while keeping losses and an enormous amount of debt obscures from view. The accounting firms of the Arthur Andersen certificate the books as fairly stating Enron's financial condition, and Wall Street was delighted to collect lucrative fees from the creative partnership that were established. Deception appeared to be a way of life at Enron. The Wall Street Journal reported that Kinley and Jeff Skilling, Aaron's top executives, were personally involved in the establishing of fake trading rooms to impress Wall Street security analysts. In an episode, employees referred to as the Sting. The best equipment was purchased. Employees were given part to plate, arranging the fictitious deals, and even the pawn lines. The were painted black to make the operation look particularly slick. The whole thing was elaborate charades. In 2006, Lee and Skilling were convicted of the conspiracy and fraud. A broken man, Kelly Lee, died later that year. One employee who lost his job and his retirement savings when Aaron crashed into bankruptcy took to the web, where he sold a t-shirt with the message, "I got laid by Aaron." But Aaron was only one of a number of counting frauds that were perpetrated on unsuspecting investors during the bubble. Various telecom companies overstayed revenues through swaps of the fiber optic capacity at inflated prices. Tyco Creative's Cookie Jar reserve and accelerated pre-merger outlays to spring-ride earnings from the acquisitions, and WorldCom admitted that it had overstated the profit and cash flow by $7 billion by classifying ordinary expenses that should have been charged against earnings as capital investments that were not deducted from the bottom line. In far too many cases, corporate chief executives, officers, CEOs acted more like the chiefs embraceedly. Officers and some chief financial officers, CFOs, could more appropriately by these be called corporate fraud officers, while analysts were praising stocks like Aaron and WorldCom to the skis. Some corporate officers were transforming the meaning of EBITDA, EBITDA, from the earnings before interest, taxes, depreciation, and amortization to earning before ITRIC, the dumb author. These scandals finally lead to a number of the reforms that should lessen that widespread conflict of interest involving managers, accountants,